Hello, I'm Joe Perino, and welcome to Sound Off. This podcast is part of the EKT Interactive Learning Network and is brought to you by Oil 101, a free 10-part introduction to the oil and gas industry. In this podcast, I want to explore the low oil price situation and answer the questions: how low and for how long? And is the worst over? Have we seen the bottom for oil prices? So where are we now and where have we come from? Well, the oil price decline started in late 2014 in the fourth quarter and slid all the way through 2015, dipping under $30 a barrel earlier this year, and I'm now speaking in June of 2016. I believe it bottomed out around $27 a barrel. Since then, it has rebounded significantly, even topping $50 a barrel just the other day. Now it's slipped back into the high 40s. Global demand is up approximately 1.8% per year versus a previous growth rate of 1.4%. Supply grew about 2.2%. and now is approximately 97.2 million barrels per day. That leaves consumption at a little over 95 million barrels per day. So our current oversupply of crude is about 1.5 to 2 million barrels a day. And it should be noted that traditionally, once the surplus is down around 1 million barrels a day or less, the pricing situation gets very tight, and you'll see we've typically seen the oil price rebound, sometimes very quickly. Now, on the producing side, Russia and Saudi Arabia are about maxed out, and added production won't help the price at all from either party. Iran is currently producing about 3.6 million barrels per day and is expected to increase that next year to 3.7 million barrels per day. Iraq is doing very well. They're producing around 4.2 million barrels per day, and they actually peaked in January at 4.4, and they have a target of going to 5 million barrels per day in the next 2 years, and they want to do as much as 6 million barrels a day by the end of the decade. We shall see. The U.S. has slipped from about 9.4 million barrels per day to around 9 million barrels per day, the result of the low oil price and the shrinkage in the rig count by almost 3/4. Now, on the downside, we've seen stoppages and problems in Canada due to the fire in Alberta, the problems in Nigeria and Libya with supply disruptions, the political chaos in Brazil, which has held up investment, which, by the way, global investment is down some 30% from its peak 2 years ago. And even, to make matters worse, global refining capacity is now in a glut point at over 101.8 million barrels a day. Now compare that. We're processing about 95 million barrels a day, so there's about a 6 million barrel per day surplus in crude refining capacity. Now, what's going to balance this out? Well, first of all, there is a natural decline rate from existing fields. And these estimates vary from 2% to 4% to 6% per year. But let's just say that it's 4% on average. That means we'd be losing about 3.8 million barrels a day at the current 95 million barrel per day production rate. But this is also offset by investment in workovers, in artificial lift, in enhanced oil recovery, and probably about 2.5% of that 4% is offset. So we're going to still see a decline of 1 to 2 million barrels per day due to the natural decline rate of wells. A second factor that is working in behalf or in favor of higher oil prices is that the big bulge in inventories in tankage and in ships offshore has started to drop. And that is moving along now, and we see a trend now for the last 2 or 3 months. Both the EIA, or Energy Information Agency, and OPEC